Markets are in chaos. Fear is everywhere. But for long-term investors, this could be the best time to buy. In this video, I've prepared 4 stocks to buy in April 2025. Whether you are growth, value, or dividend investor, I've got something for you. First, I'll present 2 blue chip mega cap stocks currently trading at highly attractive valuation, while their business remain as strong as ever. Then I'll introduce a dividend king that offers both capital appreciation and steady dividend growth. And finally, I will reveal one potential multi-bagger stock which could 5 to 10x your money over the next 10 years. Recently, markets are in the correction territory. I think you feel it by the red in your portfolio. Donald Trump has spent his first month in the White House rallying against the US largest trading partners, accusing them of cheating America and taking advantage of the world's largest economy. He has declared April 2nd as Liberation Day, when he plans to escalate his trade policy, potentially hitting the US biggest trade partners with tariffs. But does this all mean that you should sell your stocks and never return to the stock market ever again? Absolutely not. Periods of uncertainties are often the best times for the long-term investors to buy top quality companies at the discount. Without further ado, let's dive right into the first blue chip stock, Alphabet. Alphabet stock has seen a bearish sentiment in the last few weeks, which has led to a correction of close to 25% since early February. The overall sentiment on Wall Street has turned negative due to the recession fears and the tariff situation. However, the correction in Google stock seems to be overdone in my opinion. The company aggressively launching new products and is showing progress in AI models. It has recently launched the Gemini 2.5 reasoning model, which has outperformed OpenAI, Anthropic, and other competitors in key tests. Google Waymo has also announced doubling the weekly trips to 200,000 in less than 6 months. Absolutely unbelievable. Waymo will soon launch the services in Washington, D.C., which is quite a bold move as well. The massive capex spending announced by the management has raised some questions on Wall Street. However, the company can easily fund these operations. And it's also investing heavily in buybacks, emphasizing that the company is dirt cheap at these prices. At the current price, the buybacks should reduce the outstanding shares significantly, helping to boost EPS growth. Recently, Google announced the buyout of Wiz, leading cloud cybersecurity platform, which will strengthen even more the GCP, Google's cloud division. Google stock is trading at 15.2 times the EPS estimate for the fiscal year ending December 2026. This is the lowest multiple among other Max 7. At the same time, the forward EPS growth estimates show double-digit year-over-year EPS growth for the next few years, making the stock very attractive. Based on my valuation framework, Google has a potential return almost 20% CAGR over the next 5 years, or 137% in 5 years. Full disclosure, I have a long position in Google and I'm seriously considering adding more. At which level I will buy more shares? I usually check the technical levels and set the price alerts in TradingView. For Google, the buy zone in the previous all-time high at around $148 per share. Talking about risks for Google stock, as more than half of the revenue is coming from the ads business including search and YouTube, you should be prepared that during the recession the revenue will take a hit. Let me know what you think about the Google. Are you worried about the search market share lost or government's breakout of the business? Let me know in the comments below. I promise I will answer all the comments under this video. Coming to the next company in the list, Amazon. Amazon's growth engine is powered by 3 dominant business segments: retail, AWS, and advertising, each with long-term tailwinds. that promise sustained expansion. The e-commerce sector continues to thrive with the rise of digital shopping. AWS remains the backbone of the digital economy, benefiting from the global shift to cloud computing. Andy Jassy mentioned in some of the past earnings calls that approximately 15 to 20% of workloads had transitioned to the cloud, leaving a substantial 80 to 85% still on premises. He emphasizes the company's commitment to significant investments in artificial intelligence and cloud infrastructure, viewing AI as a once-in-a-lifetime business opportunity. Meanwhile, Amazon's advertising business is rapidly scaling as brands shift ad budget to high-intent retail media networks, leveraging Amazon's massive customer data and engagement. Amazon is leveraging AI tools to help both buyers and sellers. My main thesis about Amazon is retail's margins. I believe that the next generational opportunity to make money in stock market is robotics, and my bet on robotics is Amazon. I think leveraging robotics in warehouses and for delivery purposes will help to expand retail margins even more, which will generate significant free cash flow for the future opportunities, buybacks, and dividends. In my valuation, with relatively conservative assumptions of revenue growth, operating cash flow margins expanding from 18% to 23% in 5 years, I believe Amazon stock can deliver returns close to 120% or 17% CAGR. Amazon is my largest position with the north of 26% of entire portfolio. Where I am looking to add shares of Amazon. Based on the technicals, Amazon could retest the previous all-time highs at $175 per share. If you enjoyed the content, me sharing the best opportunities in the market currently, valuation frameworks, and the price targets based on technical analysis, consider subscribing to the channel as I'm looking to provide more and more value over time for you guys. Appreciate the support, and let's continue with the monster dividend stock. Pepsi is a global leader in beverage and convenient food. Pepsi is not just a beverage. Pepsi is focusing on convenient food and beverage. They have a lot of famous brands including Lay's, Doritos, Cheetos, Ruffles. In the beverage category, they of course have Pepsi, 7-Up, Lipton, etc. Pepsi is operating in over 200 countries, so it's truly a global business and diversified business. In terms of the revenue mix, 58% is food and 42% is beverage. Pepsi has a pricing power. People will not reject their favorite drinks or snacks because of 5% increase in the price. And this is exactly what we can see from their organic revenue growth. Pepsi keeps increasing prices across regions. International is growing faster comparing to the North America's business, with countries like Mexico, Brazil, and India double-digit percentage growth. Very nice to see. Pepsi pays a dividend of 3.63% and keeps increasing them for whopping 52 years. Company is a dividend king. In the latest 5 years, the company was increasing dividends for 7.25% CAGR. Currently, because of the recent stock pullback, the dividends are reaching 3.63% with the payout ratio of 65.32%. This is payout ratio calculated based on earnings. I prefer calculate payout ratio based on the free cash flow. Looking into free cash flow of Pepsi, it has $5.2 free cash flow per share, and the dividend per share is $5.42, which shows that Pepsi is paying more than 100% of the free cash flow as dividends. Normally, this is not a good sign, and we can expect dividends growth for this company slower than before. Let's calculate the potential returns of the Pepsi stock. With the assumption that Pepsi continues to grow around 5% for the next 5 years and keeps the dividends as it is, 3.63%, assuming no dividend increasing at all, we can expect 8% CAGR returns from Pepsi. In case of some recession is coming or economic growth slow down, Pepsi will perform better comparing to the market. So if 8% per year, which is slightly market beating returns, okay for you, I think Pepsi is a buy here. As for me, I would like to find something with more upside, so Google and Amazon will be priority for my shopping list, and the next company is Hims and Hers Health. This company is very volatile. It moves 50% per week sometimes, which is absolutely wild. I would not say that this company is for everyone, but I see a lot of potential here. Hims & Hers is a leading health and wellness platform on a mission to help the world feel great through the power of better health. Hims is an extremely fast-growing company with 45% subscriber growth, 69% revenue growth in the latest quarter, and keep in mind that 90% of Hims revenue is recurring revenue, which makes this business model very predictable and easy to make projections. And you won't believe it, but Hims is growing so fast. Meanwhile, it's a profitable company with $177 million in adjusted EBITDA in the year of 2024. I did a video recently on Hims where I go in depth on the business segments, growth, profitability, opportunities, and risks, mostly due to the weight loss offerings. If you are interested to learn more how I believe this company could become a multi-bagger, please go to watch that video. But with the relatively conservative assumptions of 20% revenue growth, keep in mind, currently Hims is growing north of 70% in the latest quarter. Assuming profit margin of 20% and PE multiple in the end of 2029 of 30, we get 35% CAGR over the next 5 years or almost 4x our investment. Now, very important to mention, this framework doesn't show the future, and this mostly depends on the management execution and innovations. But this is what I believe, and the full disclosure, I own all of the companies in today's list except Pepsi. There you have it. I believe these are the top 4 stocks to invest in April 2025. If you want to learn more how Hims could become a multi-bagger over the next 3 to 5 years, watch this video next. I hope you enjoyed the video. If you did, subscribe to this channel because I will make sure to keep improving and providing more and more value for you guys. Also, if you want to join the Discord server, here you have a QR code just for $20 per month. Just kidding. This is absolutely free. We will have the best investing community. We will talk about stocks, investing ideas, analysis, breaking news, and so much more. If you are interested, welcome to join. I will see you there.